All right, let's talk about something that can be a real game changer if you're buying and selling a home at the same time. We're going to break down a special kind of financial tool called a bridge loan. It's designed to solve one of the biggest, most stressful headaches in real estate. Let's get right into it.
So picture this. You've been searching for months, scrolling through listings, going to open houses, and then, bam, there it is, your dream home. It's perfect. The only catch, you haven't sold your current place yet. That's the classic timing trap, right? It can cause so much stress and, honestly, a lot of missed opportunities.
But what if I told you there's a way out of that trap? What if there is a financial tool built specifically for this exact situation? Well, you're in luck because there is. It's called a bridge loan, and its whole reason for being is to fix this timing problem for you.
So what is it really? At its heart, a bridge loan does exactly what its name says. It builds a temporary financial bridge, giving you the cash you need to buy that new home right now. It means you can own both houses at the same time, but just for a little while, bridging that gap until your old home sells and the money from that sale comes through.
Okay, the idea sounds good, right? But to really get it, we need to see how the numbers actually work. So we're going to walk through a real, but totally anonymous case study. This way, you can see exactly how a bridge loan is put together and what the whole journey looks like from start to finish.
Now this document right here, this is the roadmap. It's a bridging loan calculator. I know it might look a little intense with all those numbers and boxes, but trust me, it tells the entire story of the loan. Let's break it down piece by piece.
First up, how much money do we actually need to pull this off? The calculator just adds everything up. You've got the price of the new home, which is $1.75 million. Then you've got to add in the purchase costs, like stamp duty, another $105,000. And of course, you have to pay off the mortgage on the home you're selling, which is $490,000. Add it all together and you get the grand total needed, $2,345,000.
Now here's the really clever part. That huge number, the $2.3 million, isn't just one giant new mortgage. It's actually split into two very different pieces. On one side, you have the temporary bridging loan for just over $1.4 million. Think of this as the disposable part. It's designed to cover the gap and then just vanish. On the other side is the end debt, $900,000. That's your new normal home loan that you'll have once the dust settles and your old place is sold.
So, you're probably thinking, wait, how am I supposed to make payments on a huge temporary loan while I'm still paying my old mortgage? And that's a great question. The answer is you don't. And that's thanks to something called Interest Capitalisation, or ICAP for short. Instead of you making monthly payments on that bridging part of the loan, the bank just adds the interest charges onto the loan balance. This is huge because it frees up your cash flow so you're not juggling two massive mortgage payments at once.
Of course, that interest isn't just waived, it has to be paid eventually. In this case study, the total estimated interest that gets added on or capitalized over the 12-month loan term comes out to just over $161,000. You can think of this as the cost of convenience, really. It's the price you pay to secure that dream home without the stress of selling first. And this amount just gets paid off when your old house sells.
Okay, so now we've got all the pieces of the puzzle. Let's see how they all fit together in a journey. We're going to follow the money from that moment you're most financially stretched, when you own two homes, all the way to the end goal, a stable, normal mortgage on your new home.
Now, to see this journey the way a lender sees it, we need to quickly understand a term they use all the time: loan-to-value ratio, or LVR. It sounds complicated, but it's just a percentage that shows how much you've borrowed compared to what your properties are worth. A lower LVR means less risk for the bank and more equity for you.
Right at the start of this journey, you hit what's known as your peak LVR. In our case study, that's 73.11%. This is the highest your loan-to-value ratio will get. It happens at that exact moment you own both properties and have the full loan amount drawn down. And while that number might look a little high, it's all part of the plan and was well within what the lender was comfortable with.
And this slide just lays out the whole process perfectly. Step 1, you get all the funds. 2, you go buy your new home. 3, you sell your old one. Now, step 4, this is the magic moment. The money from the sale, $1.7 million, comes in and completely wipes out that temporary bridging portion, plus all that interest that was added on, which leaves you at the final step, number 5, with just your planned and debt of $900,000. Simple as that.
And here is the payoff. Remember that peak LVR of over 73%? Well, look where you end up. Your LVR plummets all the way down to just over 51%. This is your end LVR, and it proves the bridge was a success. you're left in a really strong, healthy equity position in your brand new home.
So, as you can see, it's an incredibly powerful tool. But like any specialized tool, it comes with some very specific rules you have to follow. If you're even thinking about a bridge loan, these are the absolute must-knows.
Okay, first and foremost, these are short-term loans. You typically have a maximum of 12 months to get your old place sold. Second, like we covered, the interest is capitalized, so you don't have to stress about making repayments on that big bridging chunk. Third, these are almost always for a home you're going to live in, not for building up a portfolio of investment properties. And finally, and this one is a really big deal, there's the sale equity rule. Basically, the bridging loan part can't be more than about 85% of the value of the home you're selling. It's the bank safety net, making sure there's enough cash from the sale to pay everything off.
Look, it's a very specific product for a very specific problem. It's not for everyone. But when the timing just isn't working out and your dream home is on the line, a bridge loan can make all the difference in the world. So the real question is, could bridging that financial gap be the key that unlocks your next move?